Have you ever wondered what a DCF is? It's one of those acronyms that comes up a lot on online investing discussion forums, but isn't always explained. You may hear people say things like, the DCF valuation of this stock is $50, or DCFs are too sensitive to inputs, or DCFs are too subjective. So what exactly is a DCF, and why are investors so preoccupied with it? Well, DCF stands for discounted cash flow. A discounted cash flow is a sum of cash to be received at some point in the future, discounted at, that is divided by 1 plus an appropriate opportunity cost. The basic concept of discounted cash flows is shockingly simple. However, the way it's implemented in practice can get a little complex. A discounted cash flow is like saying that a company is worth the sum of all of the cash flows that it will generate into the future, that being, let's say, a year's profit, a year's free cash flow, throughout a forecast period. Essentially, it's saying that the value of the business is the sum of all the profit it will generate in the future. That seems simple enough, but the problem is that investments have opportunity costs, for example, the treasury yield. Sometimes these opportunity costs are risky, other times they are risk-free. But what we have to do when we have a series of cash flows that face an opportunity cost is we have to adjust the value of each one down by 1 plus its opportunity cost. So how does this adjusting for the opportunity cost work? Well, you can see in this convenient little spreadsheet I put together here, what you do basically is you have a series of cash flows, in this case starting with $300, and growing by 10% each year to a year 5 value of $439. These are all divided by 1 plus the opportunity cost to the number of years for that year. So in year 1, you're discounting by 105, the 5% opportunity cost, and by year 5, you're discounting at 1.27. And how does this affect the value of the investment? Well, the total for the undiscounted cash flows, as you can see there in column G, is 1831, whereas the total for the discounted amounts is 1571. And if this asset is only going to last for 5 years, then these amounts basically are what that asset is worth at 0% interest rates and at 5% interest rates. But what if an asset seems likely to last longer than 5 years or 10 years or whatever period you can reasonably forecast for? That's a very good question. The idea that you can forecast all of a company's cash flows out 30 years is a pretty arrogant one, considering how hard it is to predict these things. So frequently what people do is they attach to the end of their discounted cash flow valuation a terminal value formula where you assume either no growth or a steady state growth after the discrete forecast period, that is the 5-year period that we estimated here in the spreadsheet, and then discount that at the opportunity cost minus the steady state rate of growth, if there is such a steady state rate of growth. So how do we do this terminal value thing? Well, to return to our spreadsheet here, we have a terminal cash flow of $461.20, which is calculated by multiplying the year 5 cash flow by 1.05. We have an opportunity cost of 5%, subtract a 2% growth rate from that, and we get $15,373, which is a pretty high value. So basically, our terminal value estimate here is $15,373, and our value of the cash flows that we estimated is $1.57 thousand. Adding those up, we get something just a little shy of his $17,000 estimate, and that's the value of the asset, right? Well, it's not quite that simple, because you see, the $15,373, that too has to be discounted because it's the fair value from the perspective of someone in year 5. From the perspective of us in year 0, it has to be discounted once more at 1 plus the year 6 opportunity cost, which ends up being 1.339, and that gives us finally an $11,480 terminal value estimate, which, when added to the $1.57 thousand discrete forecast estimate, finally gives us something a little under $13,000. Now, if we knew for sure that those cash flows we estimated would be the cash flows that this asset is going to produce in the future, and if we knew for a fact that 5% was the opportunity cost of capital and 2% was the perpetual growth rate in the terminal value stage, then our estimate of this asset's value, which is essentially $13,052, would be objectively correct. The problem with discounted cash flow models, though, is the fact that they involve a lot of estimates, some of which can be very sensitive. Apart from with fixed coupon bonds, future cash flows are usually very hard to predict. That gives us some uncertainty in the cash flows that we're discounting. The opportunity cost of capital is also subject to a little bit of uncertainty. Typically, people start with something like the 10-year Treasury yield because it's risk-free and therefore a return you're sure to get. However, investments that you're comparing to the Treasury are riskier, so it's generally thought that you should add a risk premium, which increases the discount rate and decreases the value a little. But as for how big of a discount rate you should use, there's no universal agreement on that at all. The bottom line is that discounted cash flows are the theoretically correct way to value a stock. If you were God and were able to predict cash flows perfectly, and were able to identify a perfect discount rate, you could use this method to find the exact value of a stock based on the future profits it was going to earn. And that's discounted cash flow valuation in a nutshell. As you can see, it is the theoretically correct way to value an asset, but it's also got a little bit of subjectivity to it and some issues with imprecise estimates. For that reason, it's best not used on its own, but supplemented with related measures such as valuation multiples. And that's about all I got. If you liked the video, leave a like. If you have a comment, leave a comment, and share the video on whatever social media you use.